Hi, I'm just going to try and see whether my title slide works because it's like a small video, I suppose.
Yeah, hi. That would be great. Yeah, go for it.
Apologies.
No, all good.
My volume was very high. Okay, let's see.
Oh, nice. Yeah, I can see the video.
Yeah, can you see like drops of
Yeah,
liquidity?
the
Yes.
water. Yeah.
Excellent.
That looks great.
Okay, great.
Awesome.
Very good. And what do you see? Do you see also other things in my background, or just you just see the
No, I
presentation?
just see the slideshow, so
Okay,
you're all
great.
good. Yeah.
Okay. Yeah, thank you.
Great. Yeah.
How do I stop share? Have I stopped sharing? No.
It looks like you're still sharing, but I can
Yeah,
stop
yeah, I
for
find
you.
it. I'm
Oh
finding it.
yeah.
Yeah, that's it.
Awesome. Great.
Hey,
Hello, Matthias. Hello, Ed. How are you?
ça va bien? You good? Ce faci?
I'm okay. I'm okay.
You in Princeton?
I am in Princeton, yes.
At Einstein Road or Einstein Drive?
At number 1 Einstein Drive, yes.
Where the geniuses meet. Okay.
Yes. Well, the male geniuses meet.
Sounds like a good place to be.
Yeah, it's very good. Very good. How are you? How's life?
Life's very good here. They just
Yeah.
made me professor.
Oh, congratulations. Oh, very good news, Matthias.
Yeah.
We have to have a party soon.
Well, whoever comes first on the other side of the continent, on the other continent.
Yeah. I will, probably not until June. I don't think so.
Good. I mean, you're taking full advantage of the US, huh? That's good. Like a great idea. I mean, it must be exciting to be there. I mean, you wrote about Wendy Brown in one of your posts. I was like, she's so cool. I mean, I don't know how she's as a person. I mean,
she is amazing.
Okay, great. I mean, sometimes people are amazing, but if she's amazing and amazing, that's just cool.
It's amazing and amazing. It's like the most unusual combo ever.
Never. Great.
Yeah.
Great. And then you have these like weekly seminars or whatever where like
we just had one this morning, yeah.
Oh wow, hi, I'm writing this book. I've been thinking about it 10 years, and by the way, I'm the coryphée in my field. That must be really nice. It's like
it was this morning. I learned a lot about psychopolitics.
Cool. And who like a psychologist or a political scientist was speaking?
He's in the English department at the University of Princeton.
Cool.
But he's doing kind of political theory.
Cool.
Awesome. Where is Martin? I'm wondering.
He's I'm not gonna say that. He's gonna be on time. He's gonna be on Argentina.
He's in power.
And so which one in the end is the book you're writing?
Oh, this is a very good question. The book has changed. I think I'm writing a book about the return of the state.
Nice.
But nice. More not an academic book, more like let's engage with the broader public book. Let's see if it works.
Cool. A little bit like for all of us, basically. I'm talking to Daniela.
No. Matthias, you're on the level where I could write an academic book for you, Professor Timan.
Oh, I mean, it's gonna be cool.
I hope so.
Look forward to it. I mean, if ever you want to shoot a draft, send it over. Gonna be happy.
I'm working on the proposal.
Okay, well, good. I think it's gonna be full house today, is my feeling. Yeah. Usually people show up after 30.
No, the sense of punctuality, knowing that there are two Germans organizing this.
Exactly, it's like 5 minutes before your time.
Yeah.
It's great.
No, I usually connect earlier just to make sure.
Yeah, of course.
Hi, everyone.
Hello, Katarina. How are you doing?
Hi, Daniela. How are you? Are you okay?
I'm okay.
Thank you for doing this. Let's see. Do you want to try share your slides? That we know that this is working. Maybe you can.
I've already done it.
Okay,
Yeah,
good.
that looks
Wonderful.
good.
I'm too late. Okay, perfect. Wonderful. All right. So see some familiar faces here. Wonderful. We'll just let people come in. The time is a bit different from what we usually do. Some people might have teaching constraints because the lunch hour here, was easier for some, but I think that's where you have your meetings at Princeton or so, no? Yeah.
Well, actually, our seminar is from 10:30 to 12, but I thought I would just take a bit of a break in between.
I see. Okay, fully understood. Fully understood. No worries. But I'm just sort of saying if we're not getting the full crowd, then that might be the reason. But we are putting together our website, and we're planning to post some of the meetings unless people disagree on those websites. Hi, Perry. Good to see you too.
Hello.
Mr. Merling, this is a first.
No, I think he's been before, but it's hiding.
Been here with us before, but you always stayed in the background? No. Really?
Well, I don't know, what do you mean before? This particular seminar?
Yeah. Yes.
I thought I saw your name at some point, but maybe
I think I was, but anyway, I believe I am the next one up next month.
That's
so
right. I
figured
wanted to announce
I better figure out, look at the lions when I'm not in the cage, you know.
Okay, so what I'll do is I'll just put the topics for the upcoming seminars in the chat. We haven't filled all the slots, but the next one we have filled, and Perry is one of them. So I'm just gonna just go out. Let's see. Here we go. So this is what's coming up. We're just confirming speakers and speaking to them, and but we can make an announcement.
Oh, Perry, I'm covering some of your stuff, so it's great. We can come back to this, or you can fire some of the shots now.
Well, you probably don't know, Daniela, that I just have published, there's a new paper on Badgett, which is misspelled there, by the way.
Sorry, I do this always.
Baghot.
Okay.
On the INET, it's an INET working paper, but it will be coming out in the European Journal of the History of Economic Thought. So it's a new interpretation of Badgett.
Oh wow!
So perhaps I'm not saying what you think I'm saying.
Perhaps not.
Yeah.
Yeah, I'll say, because I'm going to resend this. Hopefully now it's right. Okay. All right. Is Martin here?
Yes.
Okay. Hi, Martin. Good to see you. Have you done a test run with your slides as well? Are you going to have some slides? Do you want to just check whether you can get on and share them?
Yeah, I'm going to use the slides. Let me see if I can share. Yeah, I can share a screen. It's all good.
Perfect. Good. Okay, so then we're almost ready to go. Let's just give it another minute or so people can come in. It's always a little longer.
So, Katerina, this April 2024 geopolitical economy, is there a date for that? An actual day of the...
I think we're always trying to hit a Monday. So if it's, it would always be...
There's no date. It just says April.
I'm sorry. Yeah. Hang on. No, okay. So now I know what the problem is. Yeah, because we moved this one, which we rescheduled from the December. So we have to decide. I'm just going to take the geopolitical out for a moment. Just leave this. Hang on. I have to. Okay.
But we might get a lady from the Fed.
Yes, that's going to be in March. That's sort of number 2. Yeah. No, I was messing around. Sorry, with let's just put those 3 in, because we're not sure whether we can do the May one or whether you can squeeze in another one. But the reason was that we had to, stretch the calendar a little bit or bundle it up or something. Anyway, let's maybe get started. And let me apologize for the mess I'm already creating in the chat, but let me just first maybe introduce ourselves. So welcome, everyone. If you could, nice to meet you and nice for you to come for this wonderful seminar session, which we had to reschedule. If you could please mute yourself unless you're speaking and have been called on. I just wanted to briefly introduce myself and give Matthias Thiemann, my co-host of the seminar series, a chance to introduce himself. Then I will introduce our 2 speakers, Daniela Gabor and Martin Guzman, and then we'll go and let them present their perspectives on risk de-risking or risk shifting, which is the topic for today. So my name is Katharina Pistor. I teach at Columbia Law School, and I'm one of the 3 co-directors of Columbia's Center for Political Economy. The other co-directors are Suresh Naidu at Economics and CIPA, and Ira Katz-Nelson, Political Science and History. We developed some idea labs at the center, and money and finance is one of them. And I felt it would be a good idea to have like a broad-based discussion about one of the topics in money and finance that Matthias and I felt are exactly at the intersection of politics and the economy. So it's very hard to deny that when we start talking about liquidity, you don't have to think about states and state structure and political power. You can't really only talk about the economy, which of course some people would say is all about power and state structure as well, but leaving that aside. So we just felt this is really like a juncture where one has to be clear-eyed and recognize that this is actually about political economy. Anyhow, so that was the motivation for the series. We had 3 wonderful sessions in the fall. We had planned this one originally for the fall, but we're rescheduling it, as you know, and we are very happy that so many of you could come and join us for today. I'm just going to toss it over to Matthias to introduce himself, and then I will introduce Daniela and Martin.
Yeah, thank you everyone for making it today. It starts to become a repeat play. I see several people here coming here again. Me, that's Matthias from Paris, Sciences Po, professor of European public policy and interested in central banks and financial regulation. And I'm really, really excited and happy that Daniela and Martin could make it today. Katharina, please introduce them if you like.
Okay, thank you, Matthias. Okay, so Daniela Gabor comes to us from the University of Bristol. She's currently at the Institute for Advanced Studies at Princeton. As most of you will know, she's one of the leading voices for, let's say, heterodox monetary policy and macrofinance. Has written a lot, including about de-risking, but many other topics that I'm sure many of you have followed up on already. Martin Guzman is a colleague here at Columbia University, at least for the last couple of years. He used to be a Minister of Finance in Argentina and teaches at Columbia at the School of International Public Affairs. If I miss anything, please add or correct me, Martin or Daniela. Otherwise, just a brief note, I put too many chat notices already in here, but the final one gives you a sense of the next 3 sessions that we have scheduled pretty much affirmatively. We're finalizing our discussions with the speakers and we'll announce them shortly. Just keep this on your calendar. We're going back to the usual slot at 12:10 to 1:40 on Mondays. We're just a little later today. And we would love for you to come back. And also, if you have any other suggestions for topics or etc., just let us know, because we intend to keep this show running for a while. Okay, Daniela, I'll send it over to you.
Great, thank you. Let me see, I'm going to share my screen. Let me thank the organizers for rescheduling. It turns out that my arch nemesis is not the International Monetary Fund, but the coronavirus. If I go slower today, also bear with me, I'm taking my time to recover. So what I want to talk to you about today, we had a chat with Martin and thought through how to organize this. And we thought perhaps the concept of pairing liquidity and monetary sovereignty would be an interesting way to kind of differentiate our contributions. And I'm going to talk about a political economy of liquidity with monetary sovereignty, where I don't mean like the MMT interpretation of sovereignty, but I mean the distance or the degree of vulnerability to the global dollar financial cycle, and the degree of vulnerability to basically runs on your capital account. And I wanted to start by sort of setting a little bit the scene of where we are at the moment. I think we are, as a monetary theorist and a student of central banks, I think we are in a very fascinating moment, because our standard models and our standard understandings of what should be happening at the moment are not entirely sort of easy to understand, or we are in a moment, I would say, of quite kind of interesting, perplexing developments. For those of us who have followed very closely the European sovereign debt crisis and the European Central Bank, we have a polity where the central bank is raising policy rates despite inflation being supply driven, but contrary to our expectations, and I would say that I was also part of a group that expected a lot more tensions in sovereign bond markets in the Eurozone, but we're not getting that. We are getting quantitative tightening, slowing down of, or a shrinking of central bank balance sheets, while at the same time, periphery sovereign bond markets are doing pretty well. Payments or debt service is increasing very much like in the United States and elsewhere because yields are increasing on government bonds, but there is now no kind of explosive volatility or significant stress in government bond markets. If you read the Financial Times today, in the US, the kind of a similar story. This was one of the headlines that I really liked, that everyone knows that bonds are back, which is kind of interesting when you're at 5% policy rates after more than a decade of zero lower bound interest rates. And if we look a little bit at what is happening with the balance sheet of the Federal Reserve, of the Central Bank of the United States, you will see that there is some unwinding happening. The portfolio of US treasuries that the US Federal Reserve is holding, this red line, is shrinking relatively significantly. Yields are increasing, but again, no disorderly conditions. Very interestingly as well, what we are seeing is an increase in reserves that commercial banks are holding at the US Federal Reserve at the same time, or in a moment of, or in a period of supposed monetary tightening, and a shift on the liability side of the Federal Reserve from the overnight reverse repo facility, where money market funds are holding liquidity, into the US Treasury General Account at the US Federal Reserve. So it seems to me that even in the United States, which is the sort of global dollar lender, we are seeing interesting shifts on the balance sheet of the central bank that are not so easily explained or captured through standard accounts from inflation targeting regimes or elsewhere, and even standard accounts of liquidity from macrofinance. And I want to think through, why are we not? I mean, this is an interesting question for me. Why are we not in a moment of explosive instability, and what would it take for us to get there? I want to think through those two questions with, as Katarina said, with critical macrofinance, and theoretical lens to which myself and several others, some who are here with us in this virtual space, have developed. And this critical macrofinance takes as its kind of starting point, theoretically, precisely this intersection between politics and the economy that Katarina was referring to. In other words, it takes from Minsky and several others, including Perry Merlin here, the idea that we have to think very carefully through structural changes in finance and how these organic changes in financial activity and financial structure go hand in hand with changes in the macroeconomic institutions of the state. And the critical, which in the critical macrofinance thinks about these, the macrofinancial terrain as a terrain for political struggle, particularly in terms of how the institutions of the state are responding or accommodating changes in financial structure. And there are three pillars, and Katarina, will you let me know when I have 5 minutes left?
Okay.
Yeah. There are three pillars of critical macrofinance that are relevant, and I try to make this as accessible as possible. So please keep your questions or raise your hand if I have failed. This happens to me sometimes. There are three pillars that are important. First, that we live in a moment of very significant structural shifts, which I think are still accelerating from bank-based financial systems towards market-based financial systems, where there is institutional capital in various forms, working as a portfolio, slashing around the world, even in a period of deglobalization. This is not happening for financial deglobalization, slashing around the globe looking for yield. Ben Brown has called this the age of asset management. Brett Christopher has just published a book on it. And it's basically, if you unpick it, you will see that there are significant structural shifts at play in the assets of pension funds, in the growth of pension funds, in the growth of insurance companies, sovereign wealth funds, high net worth individuals. It's a story about the change of the state, but I don't have time to go through it here. It's pretty well known. And from this critical macrofinance perspective, you can think about two kind of aspects of the political economy of liquidity. One is that we have new types of money, and we have a changing nature of the liquidity imperative. In other words, liquidity itself is shifting, and the liquidity challenges for the central bank are shifting. And the way in which these challenges shift very much depends on, or vary across the global financial cycle, very much depends how far away you are from the US Federal Reserve and in which way you're far away. The second aspect of this, and I will develop in a second both of these political economy aspects of liquidity. The second one that matters, and this is where we're getting into my work on de-risking, is that it creates particular political struggles within the state between the central bank and the sovereign, the issuer or the fiscal sovereign, which are fought around what does it mean to prevent disorderly illiquidity, or what does it mean to prevent liquidity spirals. And here, two very important arguments that this literature has made. One is that the standard lender of last resort approach is destabilizing, and I'll show you that for the Eurozone. And I'll show you that also for what happened with the US Federal Reserve Bank Term Financing Facility last March when Silicon Valley Bank went bankrupt. But it also, these changes in financial market structure are generating a new logic of responding or accommodating the shifting nature of liquidity, which I've described as de-risking. That is, the central bank intervenes to preserve the investability of sovereign bonds because these are systemic collateral, and adopt new types of policymaking interventions. Market maker of last resort, which you know about a lot from Perry Merling's work, but also very interesting for me, par value lender of last resort, which the Federal Reserve introduced last year. So very quickly, the portfolio glut matters in this story, and it creates new kind of liquidity imperatives, simply because it changes the way in which credit is created in the economy, and in which lending is financed. And I'm using that definition from Perry Merling. And I thought I would just show you very quickly an example of an iceberg. This is how I like to think about the financial system, which is that what we, the regular citizen who doesn't study macrofinance, it typically sees, the tip of the iceberg, but the plumbing, or what is happening underneath, what is hidden and only is revealed itself if you're interested in questions of money, of banking and finance and plumbing, is a lot more sophisticated. And just to first set up what is the political economy of liquidity in terms of the shifting nature of the liquidity imperative. In the standard bank-based model that we had, basically, what we interact with the financial system through loans that create deposits. There is an interbank money market that we don't see, but we are aware of when crisis hits, because it's difficult to get or to find liquidity there. The price of liquidity in terms of the price of reserves goes up, and you have funding liquidity problems. Banks are not able to meet their deposit liabilities. You get queues, you get bank runs. In bond-based financial systems, where you have a portfolio glut and a much more sophisticated intersection between banks and capital market lending activity, the questions of funding liquidity are overlapping with questions of bond market liquidity or market liquidity, the Brunner, Meyer, and Peterson account. In other words, lending through bond markets is financed both through, or liquidity is supported both through the traditional central bank reserves, but also through repo markets and derivative markets. And my work has focused very much on repo market, because that's where you see the questions of liquidity hitting very, very significantly, and that's where the de-risking story comes in. And just to show you, I stopped researching repos a couple kind of a year ago because I thought it wasn't so interesting anymore. But now I'm thinking it's interesting again. Look at the increase in repo volumes outstanding in the United States from around 1 trillion before the global pandemic to around 5 trillion today, with some interesting dynamics. I don't want to bore you with the different segments, but just to note that, this the plumbing or the wholesale money markets where this market and funding liquidity come together and they can create very significant problems. It's become larger since 2020. And this is because we have new business models where the daily changes in the market price of securities is very important because of the way in which the repo contract is organized, and questions of monetary time come through. And I thought I would just advertise my latest from last year piece on how do we think about monetary time, because that's a story about liquidity and the time dimension of liquidity, which I don't have time to, I cannot, well, I don't have time to develop here. So what are these new business models? They matter for the story of liquidity simply because they tell us how cycles of liquidity and leverage are organized over time, and how they very much depend on the ability to repo finance your portfolio of securities. And just to give you an example, when a hedge fund wants to finance its portfolio of, I don't know, Greek government bonds in the repo market, it is on the day one of the transaction. We are ignoring haircuts here. It's able to raise or to borrow 100 euros against 100 Greek sovereign collateral mark to market at today's prices. If this repo transaction or securities financing transaction is longer over time, then when the price of government bonds increases or yields reduce, then our hedge fund makes a margin call, gets more collateral or more cash. It can increase its leverage. It can buy more government bonds. And there is a little bit of a story of that happening in the hedge fund space in US Treasuries today. The problem when we think about liquidity or the downside cycle is what happens when the price of these collateral securities that are collateralizing the repo transactions, when this price starts falling, then you have the price of collateral falls, for example, from 100 to 60. The hedge fund has a funding liquidity problem at the moment because it needs to find 40 from somewhere to meet margin calls. And if it finds this 40 by selling some of the government bonds that it has, that it still owns and are not repoed out, over which it has legal ownership, then it can actually reduce liquidity in the government bond market, and it can increase, or it can worsen its shortage of funding. It can worsen its funding liquidity problems. So we get liquidity spirals where the intersection of market and funding liquidity, this disappearance of liquidity in systemic collateral markets generates not only runs on repos, but also runs on sovereigns. And we have seen this in the Eurozone throughout 2010 to 2012, and to some extent at the beginning of the global pandemic in 2020. And what the response to this over the last 15 years has been a very significant central banking innovation, in my view, which is the central banks have stepped in to de-risk sovereign bonds. And by de-risking, I mean they are the liquidity providers of last resort, but they do not fix the price of the sovereign. That is what it's de-risking, in the sense that it guides the price into the direction of preserving investability or preserving liquidity, but it doesn't fix it. This is not a Keynesian central bank. And you can tell also a historical story. What I've done so far is... Yes. What I've done so far is to give a theoretical account. You can also trace a historical account of how this has developed over time. Just to make 2 points here, in 2008, we have seen central banks ignoring the problem of systemic collateral market liquidity in the Eurozone through the design of the lender of last resort facility. And that has rendered the lender of last resort a destabilizing force. Instead of delivering on financial stability, preserving market liquidity, it destroyed market liquidity in periphery government bond markets. And you can see here margin calls that the ECB made throughout the height of the sovereign bond crisis on banks that were borrowing, using emergency borrowing against periphery sovereign collateral. This has, in a sense, been remedied through a lot of political struggle, which we can talk about if you want, with Mario Draghi's whatever it takes, then Christine Lagarde's closing the spread, and the more formal introduction of the transmission protection instrument in the Eurozone. Basically, the European Central Bank is now very clearly guaranteeing, under certain conditions, with certain conditionalities, guaranteeing the liquidity of sovereign bonds in terms of preventing liquidity spirals. But this has not been the only innovation. This market maker of last resort has not been the only innovation. What I think it's even more fascinating, and this is probably me and 5 other people in the world who think that, is the introduction of par value lender of last resort, which the Federal Reserve of the US Federal Reserve did last year in March in response to the Silicon Valley Bank problems, and what you see in this graph here, it's over a year, so it's a time-limited facility. But what it does, it eliminates a par value. It eliminates mark-to-market of collateral from lender of last resort. It eliminates the problem of market liquidity of sovereign collateral from lender of last resort. I think this is fascinating in many ways for students of central bank, because we know that, and probably Perry Merling, who just told me he has a new interpretation of budget, might contradict me here. But since budget, there is this intuition that you have to lend, but against good collateral. And here you can argue good collateral or not. A standard practice of central banks has been to say, good collateral, we preserve the problems against good collateral by risk management of collateral that we accept. And the US Federal Reserve has eliminated completely the risk management aspect of, at least for US treasuries. And you can see here how traditional lender of last resort, market maker of last resort, mark-to-market lender of last resort, which is the primary credit facility, has basically disappeared, whereas the par value lender of last resort has increased quite significantly over the last year. It would have increased more, but there are certain liquidity and leverage regulations that are making it more expensive for banks to finance their portfolios of US treasuries there. So what we see here, and I'm going to finish with the conclusion now, Katarina. What we see here is significant institutional or innovation, or if you want, since I think we are now back into the territory of central banking is an art rather than a science. We are seeing that central banks have perfected the art of monetary de-risking, which to my mind means that we will not get any explosive instability in finance over the next very long time. So this is my controversial claim is central banks have put in place some very significant backstops. Very interesting because they are such obscure technicalities involved in the design. They came without a lot of political contestation, although they go against many kind of the fundamental tenets of prudent conservative central banking. So I'm going to stop here by summarizing the political economy of liquidity from a critical macrofinance perspective, which is we have to think, when we think about liquidity, we have to think about transformation, monetary transformations, and the eternal search for new par value instruments away from the state. We have to think about it also as a degree of vulnerability to the global dollar financial cycle. And I will let Martin tell you what happens when the vulnerability is very significant. But it's always, to me, liquidity is always a macro-financial question in the sense that it pushes the central bank or central banks to engage in political struggle over how to accommodate new par value instruments and the political problems that are raised when those par value instruments somehow entangle the central bank with a sovereign as a debt issuer. I will stop here. Thank you.
Thank you, Daniela. This has been great. And we'll hand it over to Martin. And if you want to share your slides, please go ahead.
Just a short interruption to say, if people in the audience have questions, you can already feel free to put them in the comment, so we can come back to them after the presentation of Martin. Thank you.
Yeah, and if you're not speaking, please mute yourself. Sometimes you just hear a cough or something or a phone ringing. Just mute yourself. Thank you. Okay, Martin.
Thank you, Katharina and Matthias. And so we had a chat with Danielle before, as she explained, and we thought it would be good to complement our presentations with titles liquidity with and without monetary sovereignty. So I'm going to focus on the second block. And basically, this helps me to connect a literature on sovereign debt crisis resolution and sovereign debt restructuring to the theme of the broader theme of macroeconomics. So the motivation of this presentation is twofold. First, it's about thinking how the scope for countercyclical macro fiscal policies in countries that have monetary sovereignty versus those that don't have monetary sovereignty. And second, to think about the role of that policies in countries that don't have a monetary sovereignty. And I define monetary sovereignty basically as a situation in which a country has a strong demand for domestic currency, meaning that the currency performs the three functions of money. It can be used as store of value, unit of account, and medium of exchange. And by the way, do you see my slides well? Because I see, okay, okay. And the second condition is that the debt can be issued in the local currency under domestic law. This is not the case for many countries in the world. It's actually not the case for the majority of countries in the southern hemisphere. In the extreme, countries have very not having.
Can I just please ask everybody again to please mute yourself? There are some people who have not muted. Please mute yourself. Sorry about Martin.
No worries, Katharina. So even for a country not being able to issue a reserve currency makes the country very likely to fall under the category of countries without monetary sovereignty. So Daniela started her presentation with a picture of the falls in risk premium in the countries in the periphery of Europe. And what we're seeing today in the Global South is exactly the opposite. So just to give you some context, let me show you two figures here. What I'm going to speak about is more general, but today in the current global context, this theory on sovereign debt crisis resolution and how to approach stabilization policies without monetary sovereignty is even more relevant given what's going on. So here what you see is evolution of public and publicly guaranteed debt in low-income countries and middle-income countries. You see it by creditor type since the fall of Lehman Brothers, the 2008 US financial crisis, and you see a very significant increase in debt levels in this group of countries. And there is an increase to the exposure of the bar in brown there, which is the private creditors, the bondholders, not just private creditors, but private creditors that provide financing in the form of bonds. So this is what happened after the massive creation of liquidity, what Daniela called the US-led financial globalization in 2008 mainly, but this is coming from before, that became global. And the one important aspect here to understand the issue of macro fiscal policies without monetary sovereignty is that these debts were not only issued in foreign currency, but also in local currency, but held by investors that don't really invest in the real economy in the country. They're called the tourist investors. Typically investment funds and hedge funds based in New York, Connecticut, or London that see short-term opportunities by moving portfolio capital. They can exploit carry trade opportunities. And the second figure that I wanted to show you to provide some context is this one that shows that the proportion of low-income countries under that distress. The red bar is distress already, according to the IMF. This is the IMF debt sustainability analysis. High risk of distress is in the orange bar. And what we've seen over the last decade or so is an increase in that distress levels. Again, 2008, and then the pandemic, and then the war in Ukraine, which led to a response from central banks of advanced economies of increasing interest rates and reduced liquidity in the global economy. So this is creating more troubles for many countries, not for the global economy, but for many countries in the southern hemisphere. Good. So what does standard counter-cyclical fiscal policy stance is the ones that assumes monetary sovereignty? Well, that the government should be able to do counter-cyclical policy, meaning that the stance should be expansionary in the through, and it should be contractionary in the boom of the economy. But this relies on capacities, constraints, or financing possibilities that not every economy has. Just to meet my time constraint, let me skip the part that refers to counter-cyclical macro in countries with monetary sovereignty, which you know very well, and Daniela also discussed to some extent. And let me focus on the issue that there is more reduced scope for counter-cyclical macro policy in countries without monetary sovereignty. So the key point here is the money demand and the lack of well-developed domestic capital markets. When the public sector pushes an increase in domestic liquidity, that puts more pressure on exchange rates than in economies that have monetary sovereignty. And the pass-through from the depreciation of exchange rate to inflation is relatively high in this group of economies. So to do counter-cyclical macro policy in this context of lack of monetary sovereignty, the government need foreign currency liquidity. And there are basically two ways of having foreign currency liquidity. Either the central bank foreign exchange reserves are used, or the government borrows in foreign currency. But part of the literature, what it analyzes and what I will discuss later in this presentation, is that can also harm further the monetary sovereignty of the nation, even more so in the downside states. So in a case in which there is a recession, but there is no debt distress in a country without monetary sovereignty, the public sector may have the capacity for running an expansionary fiscal policy. It may even resort to selling reserves or to borrow in international credit markets. Let me quickly skip through this. But things are different under that distress. If there is no possibility of using foreign exchange reserves, which is what marks that distress for countries that have a debt in foreign currency, then the options are much more limited. The typical one is to resort to an international lender of last resort. Historically, it's been the IMF, although the role of China as a lender of last resort, as recent literature shows, has been growing over the last decade, a bit more than the last decade. But this, of course, has other consequences. Typically, there are two possible use for funds that come from the lender of last resort. One is the most common behavior, the way the IMF funds are most commonly used is not really for counter-cyclical policies, but for bailouts of existing creditors, and we can discuss the empirical literature over the Q&A. And the other one, which is the one that is actually supposed to be the role, is for counter-cyclical policy. But resorting to foreign lenders of last resort may imply a loss of sovereignty in even a wider notion, given that there are typically policy conditionalities. So this is how this is where the literature on sovereign debt restructuring enters. In situations in which the country doesn't have the capacity to run a countercyclical policy, and there is a recession and there is a situation of debt distress, what the literature on sovereign debt sustainability shows is that there may be destabilizing effects from no restructuring debts, meaning that further adjustments of the macro policy, a contractionary policy stance may lead to a deeper recession, which makes that even more unsustainable. It's what it's called negative endogenous feedback effects that take the economy further away from equilibrium. So a situation of austerity may not play any positive role for taking the economy back to a situation of equilibrium. But if the endogenous feedback effects associated with contractionary policies are sufficiently strong, it may take the economy further away from the equilibrium. Sovereign debtors from emerging and developing countries issue bonds that include a risk premium. Coupons recognize that there is a risk that the debts may not be repaid under certain circumstances. But the way legal frameworks work is that when a sovereign borrows, despite the fact that it issues debt with risk premium, the sovereign doesn't have the right to declare a situation in which the transfers from the debtor to the creditors are not made, and that's it. The creditors keep the right to receive the coupons, including the risk premium, until they voluntarily accept to exchange their bonds by new bonds, which is called a sovereign debt restructuring. And there is no international mechanism. There's nothing equivalent to a bankruptcy code for sovereign nations that borrow in foreign currency or in any currency. So the power dynamics matters. This is a field in which there is an intersection between economics, politics, and law. There are decentralized negotiations between a sovereign debtor and many different creditors, mainly bondholders, and also official creditors at times. I'm going to tell you a little bit, if we have time in the Q&A, about what's going on now and the role of China and the Paris Club. But there's a myriad of creditors, and the debtor has to negotiate with all of them to achieve a certain amount of relief that allows the debtor now to run a macro policy that enables economic recovery. I'm not sure how I'm doing with time, but Catherine, if I'm short of time, you will let me know. I have 3 more slides.
Go ahead. You're fine. You're fine. A couple of more minutes. It's about it. I'm just looking, 3 more minutes you have.
Okay, that's great. So debt sustainability. You see there an equation, a definition that is the cornerstone of debt sustainability analysis. It's the definition of debt stabilizing primary fiscal surplus. S, it's the primary surplus to GDP is equal to the debt to GDP ratio, D, times the difference between R and G, the nominal rate on the debts average and the at which debts are rollover in the future or expect to be rollover, and the growth rate of output. But the point of sovereign debt sustainability analysis is that S is a fixed point. Mathematically, it's an object that is affected by the fiscal policies itself. It's spending minus, is a tax revenues minus spending, but spending and tax policies affect through the endogenous feedback effects the fiscal outcome. And what's an economic equilibrium might not be a political equilibrium. It might just be incompatible with an unstable society. So there are constraints that have to be taken into account that go beyond economics at the moment of debt sustainability analysis. And that means that debt sustainability analysis faces different constraints in countries with and without monetary sovereignty. In the case of countries without monetary sovereignty, there is a higher relative importance of the balance of payments constraint, the external constraint. Let me then finalize referring to a current issue that is important today in the global economy and over which some literature is emerging, which is the issue of comparability of treatment and the consequences that it may have for building up monetary sovereignty. So there's too much information here, but I'm going to tell you in 30 seconds what's going on. As I said before, after the 2008 US financial crisis, there was a boom in bonds. Countries that had never accessed international credit markets placed bonds in international markets for the first time ever, and they issue bonds in multiple currencies. And today, many of these countries are under distress and they are restructuring their debts. And even though debts are issued under domestic jurisdiction, should be treated in a way that is the decision of the debtor, it doesn't really happen that way because the IMF acts as the referee implicitly, although there is no international legal framework that says that that should be the case. But it's the way it works. And the IMF produces that sustainability analysis and defines thresholds that have to be met in terms of debt payments, what's called gross financing needs to GDP, foreign currency debt service to export, and debt to GDP levels. And it groups all the debts, it pools them. So now what we're seeing is demands from bondholders that hold debt denominated in foreign currency for restructuring, getting haircuts on debts on domestic currency, such that these constraints imposed by the IMF in their debt sustainability analysis are relaxed, and therefore they can get more. But what the literature is discussing today, and I quote a paper at the end, at the bottom of this slide, is that that could have consequences for the future of monetary sovereignty in countries that default on their debts in domestic currency, which is a rarity. So to conclude, much of the analysis of macro and financial debt policies over the business cycle focuses on economies with monetary sovereignty, but they constrains the mechanisms of transmission of policies to outcomes, and therefore the trade-offs are different in economies that don't issue reserve currencies and that don't have well-developed domestic capital markets. And the field of sovereign debt restructuring relates mainly to the latter group. Thank you.
Thank you so much. And thank you both for keeping in time. If you stop sharing your slides, then we can all see each other. I'm sure we can go back if people have specific questions. I already see Matthias' hand up. So let me just maybe just throw out one thing. So two broad comments, and we might come back to them. One is that, of course, monetary sovereignty seems to be like a continuum rather than a binary, and I think your definition of it suggests almost as much. The other point is that monetary sovereignty, or the absence of monetary sovereignty in the global south and for many countries around the world, is not independent of the structure of the global financial system that we have, right? So there's no, and I think maybe that we can tease that out a little bit more. It's not a state of the world that we couldn't possibly change, but I think maybe we can try to figure out a little bit what interactions there might be. But before we go to the audience, maybe Daniela, do you want to briefly respond to what Martin has said or amplify some things that he has said, and then we turn to the floor?
No, Martin's analysis strikes me, and then his experience strikes me as very powerful in the sense of asking through or thinking through what does it mean to do countercyclical policies when your room for maneuver it's so narrow. I would wonder. So the way that I understood some of the arguments, it seems to be that with deeper capital markets, monetary sovereignty or this narrow room for maneuver would kind of expand a bit. And from my analysis of global south countries, I'm not very clear why this would be the case, Martin, because you'd still have, even with very deep capital markets, if non-residents are there and they are carry traders who respond to who have liquidity concerns and yield concerns, I'm not quite sure how it would make a very massive difference to your analysis. But yeah, I don't know if we disagree there or we just align what I don't understand or I haven't fully understood it.
Should I quickly respond, Katerina?
Yes, please, go ahead.
So also to the points you made, or one of them, certainly the way we address this phenomenon of monetary sovereignty is not like something that it comes from nature. It doesn't come from nature. It can be changed, and it depends on institutional structures. If I may make a comment about policy from my previous experience as a policymaker, the one thing that we did in Argentina when we restructured the debt in foreign currency under foreign law was to give equitable treatment to the debt under Argentine law in foreign currency. So both in foreign currency, but under Argentine law. And this had to do with the idea of respecting the domestic law and not creating a precedent that would be taken by market participants as, okay, it's better to provide financing under foreign law because that harms the domestic capital market. And that connects me with the point Daniela raised. And I don't think there's a disagreement here, Daniela. I think it has to do with how with the definition of capital markets. So the capital account regulations, I would take them within the definition of a domestic capital market. So if we have a domestic capital market in the context of a totally liberalized capital and financial account, that is going to create much instability also. But the point here is that there are, say, in the extreme, the US, everyone wants a dollar. So it's a country with strong demand, not just domestically, but internationally. On the other hand, Argentina, a very weak currency, very bad history of inflation, and no savings in the economy, which means that the country cannot develop a domestic capital market. So the country ends up, for the time in which it needs counter-cyclical policy, it either has to do it in a way that creates significant inflationary pressures, or it has to borrow abroad, bringing other troubles with high probability in the future, or it can't do it. So it's in the sense of having access to resources for counter-cyclical policy and an architecture that prevents too much instability that I define here the concept of a well-developed domestic capital market.
Yeah, and the IMF seems to be counterproductive here, if I understood you correctly. Matthias, I think you had a question.
Yeah, thank you to both of you. And I think so this intersection of economics, politics, and law, the way that Martin put it, it was really, and also Katarina, I think is really a great way of setting this up. So I was listening to both of you, and I was wondering if both of you could expand a little bit more about the interaction of the Ministry of Finance and the central bank under conditions of monetary sovereignty and under conditions of lack of monetary sovereignty. And in particular, I'm thinking here, and I'm sharing this for the US, I'm thinking about the attempt actually the regulatory push for central counterparty clearing of repos by 2026 of all repos. So this is an attempt to rein in the repo market that Daniela has shown. And I was wondering if we can think a bit more what this teaches us about critical macrofinance, like how they interact with this. And on the other hand, Martin, and I know, for example, Mattia Lupi is in the Zoom room who's writing on the Italian central bank in the 1960s and 70s, which also was struggling with this external constraint and trying to stabilize the country. Is there very naively asked from a non-economist, is there no way the Argentinian central bank could just say, I am going to finance the debt of Argentina? And why is this not working? Sorry for asking a question that every economist can answer, but I can't. So I would be grateful for an answer. Thank you.
I don't know if I should start or let Martin give you. Everybody has every economist has a very different answer to your second question. Why doesn't the central bank monetize deficits with or without monetary sovereignty? But I would say, so going back to the question of the relationship between the central bank and the Ministry of Finance or the Treasury, I think there is a broader political economy question, and then there is a CCP angle to it, which is a bit more obscure for me and you and several others. But broadly, what I would argue critical macrofinance teaches us is that you can have a preservation of the status quo relationship that we describe as monetary dominance, right? Which is what the European Central Bank in particular has been writing about, because of the nature of the political struggles in the European polity questions of this relationship are much more political. And so under monetary dominance, you have inflation targeting central bank, targets price stability, and is nominally committed to not monetize public debt, which in the Eurozone means you can't buy in primary markets, but you can buy in secondary markets, and you don't buy to help the government, you buy to preserve financial stability. So this is how I guess critical macrofinance would answer your question, that we are getting this relationship is mediated by questions of financial stability and safe asset issuance. And when this is the case, central banks can ultimately decide to basically preserve liquidity without changing or without giving up the politics of monetary dominance. And this is what is fascinating to me, that in the Eurozone case is much more obvious, that you have political struggles at the beginning of the sovereign debt crisis, where the ECB, for a variety of reasons, says, you know what, I want the Treasury to deal with the treasuries and the ministries of finance to deal with this on their own. This is not our problem. It's a fiscal problem. Liquidity problems are a fiscal issue. You deal with them, not us. And then you have market participants, financial market participants, repo market participants saying, you know what, actually, it's not a fiscal problem. And by Benoît Cœuré in 2016, Benoît Cœuré, who was then on the board of the European Central Bank, he said, yeah, well, it's not a fiscal problem. Actually, it is a central banking problem, because government bonds are a form of high-powered money for market-based finance. And because they're a form of high-powered money, we have to intervene and monetize or indirectly monetize for financial stability purposes. So this is, to me, the paradox of liquidity, of market liquidity that we have in thinking about this relationship, is that central banks have basically seen no significant weakening of their legitimacy in terms of the discourse of independence, while gaining political power towards treasuries. I'm not saying that this political power is ultimate, because the US Treasury can do big fiscal, and nobody's going to come and say, from the Federal Reserve, going to come and say, hey guys, what are you doing? And maybe that has to do with a hegemon position, et cetera, et cetera. So it doesn't, this is, the short answer is, it doesn't fundamentally alter the relationship between the fiscal and the monetary authority. It reinforces the power of monetary authority. The move towards de-risking, it reinforces the power of the monetary authority, and at the same time, it preserves financial stability in ways that I didn't think were possible. But this is clearly a very different answer for Argentina, and I would guess it's also a different answer for Hungary. Hungary is an interesting case of a derivative of Argentina in some ways, and I can elaborate on that if you want.
Mm-hmm.
Martin, do you want to respond?
Yeah, that's great, Daniela. And so I'm going to complement Daniela's answer by referring to other types of economies. But I think the more general issue of the institutional frameworks that define the institutional and political frameworks that define the relationship between the Ministry of Finance and the central bank have to be framed in the broader context of social relations. So let me respond with Argentina that you asked about, which is probably a kind of extreme example in the world, in the sense of how the relationship between the Ministry of Finance and central bank works. In the 80s, in the 1980s, the country ended up with a hyperinflation, and throughout the decade, there was no instance in which the central bank would say no to providing financing for the public deficits. But the money demand was getting weaker and weaker. By then, it was, you remember, it was the post-Volcker raise in the increase in the interest rates, which created a crisis of debt in Latin America, including Argentina. So the public finances were asphyxiated, and there was a significant distributional conflict in the country, which makes reducing the deficit very difficult. But then the country ended up with hyperinflation. And in those extremes, there are significant political changes. The country almost abandoned the currency. Not the currency, but at least it did abandon the possibility of doing a monetary policy the decade after, instituting by law a regime of convertibility that tied the domestic currency 1-to-1 to the US dollar. And the country ended up going to the other extreme. When there were shocks, the country could not respond. It could only respond to the first shocks. When it had, given the way the regime worked, it had some space to respond to the initial shocks. But then 1998 and 1999, the Russian crisis, the Brazilian crisis, the East Asian crisis, 1997, the country ended up in 2001 having the worst economic crisis of its history with 23% unemployment rate by then. So it goes from one extreme to the other. So ultimately, the way these relations work, as I said before, have to be put in the broader context of social relations. Today, we are in Argentina, the discussion went again to another extreme, complete abandonment of the currency, setting the dollar as a currency, dollarization of the economy. This is being pushed by the current president, and it's a serious possibility, which would mean total loss of monetary sovereignty. So ultimately, to regain monetary sovereignty, there are more fundamental and deeper problems in the society that need to be addressed.
Thank you. The floor is open for other comments. I'm almost inclined to cold call on some, for example, on Perry, and help us figure out sort of the hierarchy of the global financial system, including the hierarchy of sovereign debt and monetary policy. Here goes up his hand. Perry, please.
If I'm going to get cold called, I might as well volunteer. I'm reminded that you teach in a law school, so that's what they do in law school. So I have, I guess, two as I was listening here. So this idea of monetary sovereignty, and as you said, Katerina, that it seems not to be a binary but a continuum. So I would go beyond that and say what it is actually what I call the international hierarchy of money. Okay. That there's international reserve currencies, and then there's a second level below that that's basically the global north. Okay, and there's a second level below that, the global south, that's actually integrated with the international monetary system in one or another. And then there are countries that are really on the far periphery. So when I teach this, I teach sort of 4 layers. And the point of this is I think very much compatible with this conversation here, that depending on where you are in this hierarchy, your problem is different. Okay, every layer faces the problem of how do I engage with this global system that has its own sort of laws of motion and its own international credit cycle, and I have to figure out, as a finance minister or a central banker, what is my room for maneuver? What are the policy tools that I have available to me? And it's going to be different at different layers. Okay, you're not also, as Martin mentioned, you're not sort of doomed to be where you are. You can conceivably move layers, with financial development, because, and this didn't come out in the conversation, but I think it's implied by something that Martin was saying, that he was interested in developing capital markets, internal capital markets inside Argentina, that this hierarchy, international hierarchy of money, is also a hierarchy of hybridity, okay? Where the lower layers, there basically aren't private capital markets, okay? And the higher layers are in fact integrated with global capital markets. And in the middle, you're half and half, okay? So the hierarchy and hybridity, which of course then goes with the relationship between the central bank and the fiscal authority, because how big is your financial sector domestically? And will very much indicate, and what is the central bank's, they're operating the economy through the domestic financial system. So if there isn't any financial system, what is your room for maneuver? So that's the first point about really digging into this concept of monetary sovereignty and maybe problematizing it or connecting it with what I call the money view. Okay, and so we've had long conversations, Danielle and I, for years about is the money view critical macrofinance, or is it just macrofinance without the critical, or what is it? Okay, so that's the first point. The second point, and this is specifically to Daniela, who's very surprised that the wheels are not falling off the cart. Okay, so I think there's a dimension of the system that you're not, which hasn't been mentioned today. Okay, why aren't they falling off the cart? Okay, I think the reason you're focusing on shadow banking and on money market funding of capital market lending. Okay, but there's another feature of globalization, which is the integration of global money markets and the dollar system, the liquidity swaps between major central banks that are keeping exchange rates in line with each other. Okay, and the lender of last resort, the extension of Federal Reserve lender of last resort to the global South through the FEMA repo facility, through various things that have been invented or extended. In fact, during COVID, there has been an extension of the backstop, and the Fed is very much now lender of last resort for the whole world. Okay, that has become politically acceptable in the United States, apparently, which it was not during the financial crisis of 2008-9. You may remember that the Fed was in fact called on the carpet in Congress. Like, who gave you the authority to lend to these European banks? And that was Bernanke, actually, who was called on the carpet. And he sort of did not use that teachable moment. Okay, but it is very much more so that the Fed has been doing this during COVID-19 without any complaint whatsoever. So it appears that the world accepts that the Fed is the global lender of last resort. And the key instruments here are the liquidity swaps, central bank liquidity swaps, and the FEMA repo facility that has been created. I just have this paper that was just published in the annual Economic History Annual that is trying to speak to historians about this. So it's not in math or anything like that. But so these are institutional developments. This is exactly the point, that the international hierarchy is in motion, and crises are moments of institutional evolution. And COVID was one. COVID was an important crisis.
Yeah,
that's where I'll stop.
Yeah, no, thank you. So if I can just chime in here. So I think that this is hugely interesting, but I'm also just wondering, the U.S. Central Bank is of course also bound by, local law in terms of what is the purpose of the central bank, what are its policy options, and it has of course expanded them over time. We know that too, but I'm just wondering the extent to which they really take into consideration the concerns in the global South, or are responding to the degree to which American financial institutions, private institutions in particular, are integrated with economies in the global South, and they're basically creating also a floor for them. So they're following the private sector rather than necessarily creating, sort of the conditions for a global system that could reorganize itself. Maybe that's the first point. The other point is I'm just wondering about the hierarchy and how people can move up in the hierarchy, because the fact that most former colonial countries have highly underdeveloped financial systems is not just an accident of history, right? That is part of a geopolitical structure where you have major financial centers in England, in the United States, and earlier, of course, in different countries, but that provide the refinancing, the liquidity to major intermediaries, and that's completely absent in many of the developing also the former colonial countries and further in the countries that emerged from colonialism later on. So I'm just wondering how much flexibility there really is, and whether we have a single country, maybe outside China, which is still protecting its own monetary system very much, that really shows how you can move up in that system and really play a very different role in it to make that point. But that's sort of, Daniela, I see you coming back.
Perry, do you want to respond to that?
Because I just wanted to just connect that Martin had mentioned about how after the global financial crisis, many of the countries in the global South found out that they could tap global capital markets, dollar capital markets, basically for the first time. That's true. Okay, so now that's all shaking out with this debt sustainability and debt restructuring and so forth. But this is how the system grows, through over expansion and then contraction. And so I think that it's not necessarily, I mean, we make our own futures, but not under conditions of our own choosing. That this was taking advantage of the crisis of 2008, when in fact the global North was in a big trouble, and the reach for yield from insurance companies and so forth made them willing to consider the global South. Oh, maybe we should be lending to them. We can get 10% down there. We need 10%. My business model needs 10%. So it's not a domestic policy choice necessarily. It's taking advantage of whatever situations you have and having in mind, let's use this. For something.
Daniela,
That was just, yeah.
Thank you. Daniela, I want to come back. And then Martin, if you want, and I see Matthias again, but I also want to encourage other participants before I cold call them to come forward.
Yeah, I've been also wondering about this, what is the continuum and how do we think about the continuum of monetary sovereignty, in particular because the idea that if you develop local capital markets, you are somehow going to be better insulated from the global financial cycle is something that the IMF and the World Bank have been pushing for since 2008, and I think from the G20 presidency, German presidency. And it's not very clear to me that having deeper local capital markets means that you are somehow higher in the hierarchy, in the international hierarchy, in the sense that I interpret it to mean that you have more policy autonomy, or you have better instruments to protect yourselves from whatever the US Federal Reserve is doing. Because I mean, Perry, we don't disagree on the role of the Federal Reserve as a global lender of last resort, but the politics there is much more complicated, I think, than just saying, the Fed just backstops and everybody's happy. There is a certain inequality of access to the lender of last resort. If you go to the FEMA repo facility, you need to have US Treasuries, otherwise, and even if you have US Treasuries, you're not going to access a lot of it. So it to me, it's not so straightforward to think through. And I think I heard that in Martin's response to my comments, because Martin said it's about access to domestic resources. Now, to me, access to domestic resources is very different from deep capital markets. And I don't know, Martin, if you meant access to domestic financial resources or access to domestic resources in the sense of, do I want to create structural changes in my economy that would give me much better export performance and would allow me to not, accumulate or not go into a trade deficit every time I do fiscal expansion counter-cyclically. That is a different story to me than, and I'm thinking about the example of Hungary, because Hungary under Orban tried to do something very interesting, which is Orban tried to change the position of Hungary in the international monetary hierarchy by saying, look, guys, you convinced us in the 1990s to privatize our banks, privatize our insurance companies to Western finance or global finance. And when he took power in 2010, he went down the financial nationalism route, by which he said, we want local ownership of the financial system. We want to be able to not depend on, the European Central Bank, also for a variety of reasons. And he did that by basically trying to minimize the amount of non-resident presence in local sovereign bond markets, by basically creating a tighter relationship between the Ministry of Finance and the central bank. And this worked for a while, but it stopped working a couple of years ago. And what you see when Federal Reserve started to increase interest rates, Viktor Orban didn't tell anybody, but he went back to exactly what his predecessors did politically, which is to find very creative ways of attracting carry traders, non-resident investors from London and Wall Street. So what is the lesson from Hungary? To my mind, the lesson is that you can't, that there is no safe space, except for if you're the Eurozone, and even there is no safe space in the international monetary hierarchy where things look better. Yeah, I'm not so convinced.
Katarina, Katarina, you need to unmute yourself, please.
I'm sorry. So I saw Martin had unmuted himself and Matthias had raised his hand. So either of you just toss a coin. Martin, do you want to respond directly to the debate?
Or Matthias can go first and then I can.
Okay, that's very kind of you, Martin, because I think I have a question to you. So I think it's good to go first, maybe. Because I have a question. We started to talk about the relationship between the central bank and the fiscal. Now, when Daniela and Perry were speaking, I have another question, which is the relationship between the central bank and the private actors. And I want to ask this question again for countries with monetary sovereignty and countries without monetary sovereignty. So the question for the countries with monetary sovereignty, here I want to use the example. So what does it do to the system if you have a lender of last resort? And Daniela, to me, somewhat surprising, you said there will be no troubles. Okay, it's provocative. It is interesting, and it might be true. I think what in COVID, and Perry mentioned the COVID crisis, I think the Fed and the Treasury were very surprised about the power of the hedge funds to move the money market and to move the Treasury bond market. And in a sense, the hedge funds, possibly or probably also because of the lender of last resort and market maker of last resort function of the Fed, the hedge funds have and Sahil Dutta, who was here earlier, has spoken about this, have gone in massively, highly leveraged, low margin trades that can move the markets if their bets go wrong. And so I have the feeling that the power relationship between hedge funds and the Fed in the center of the system has swung into the direction of the hedge funds, which is why the political side is now trying to get control again. So I was wondering if, Daniela, you want to comment on this. And for the without monetary sovereignty, I listened recently to a paper by Anina Kaltenbrunner, who tried to show that many central banks during the COVID crisis really very massively engaged in buying up sovereign bonds in the global south, thereby stabilizing the system, trying to use capital management measures not to let the money managers out, and so on. So there was some degree of agency, maybe not for Argentina, I understand, but so some countries in the south that she showed, the central bank was basically saying, okay, I'm going to buy up everything. And then the question was, when am I going to let the money managers out? Are they going to have to take a loss? Are they not going to have to take a loss? And it was about this question, am I going to have private actors to take a loss, or am I going to let them out and then impose the losses? If you see what I mean. If I'm not clear, I can try to
And just say what you mean by let them get out.
Well, the question was, is the central bank going to directly and immediately act as the market maker of last resort in the COVID crisis? So it's going to say, any asset manager, any hedge fund who wants to get out of my country's government bonds, here I am, I'll buy it. And in some countries, that was the case. In some countries delayed that. Mm-hmm.
Thank you. Martin. No, you have to unmute yourself, please. Thank you.
That's right. Thank you, Katharina. 3 remarks. So first, I titled my presentation Liquidity Without Monetary Sovereignty, but much of the discussion had to do, at least on my presentation, with problems of sustainability, right? When a country has a weak demand for domestic currency and needs to rely on foreign exchange liquidity and loses foreign exchange liquidity, it's very difficult to distinguish or to have a clear dichotomy between liquidity and solvency. Why would a solvent country where there is no perceptions of unsustainability of the debt would be illiquid? So these two concepts are actually intertwined. And when a lender of last resort provides funding in situations of illiquidity, we have to take into account that illiquidity is related to problems of sustainability. Otherwise, the consequence will be just to pay the creditors to do a bailout. But if there was a real sustainability problem, we end up with a structure of debt that is different, more exposure to the debt to the super senior creditor, the one that has a preferred creditor status, which is IMF, the debts that cannot be restructured. So this was an important clarification I wanted to make. Second, Matthias, on your question of specific about the lender of last resort, you seem to be referring, if I understand correctly, to 2 different types of lender of last resort. One is central banks. I have a good friend, an economist from one of our neighbor universities, used to refer to the Central Bank of Peru, not as the Central Bank of Peru, but as the Republic of the Central Bank, right? It's being rather than the Central Bank of the Republic of the Central Bank. But that's just a joke, but that's one case in which you have an institutional design in which the monetary authority has more power than anyone else, probably. And on the other extreme, you have Argentina, the example that I gave you, that the central bank has never said no to a request from the Treasury for financing deficits, and in a context of significant distributional conflicts are unresolved, over time, that creates significant inflationary pressures. It decreases the confidence in the currency and creates vicious cycles. So I think the discussion needs to be contextualized, right? And then when it comes to the international lender of last resort, we don't have, I mean, the world is power rules. The economies don't work in a vacuum. And therefore, we cannot think of an international lender of last resort as a technical institution that judges when a country needs liquidity. These are the IMF is a political institution. It has shareholders. The shareholders are represented by the finance ministries or central banks or the treasuries, and they represent certain interests. And you're going to see very different treatments to one country versus another, even under similar economic circumstances, precisely because the lender of last resort tends to be a political institution. So I think we need to understand the international politics to understand the role that lenders of last resort play. And the final remark regarding Daniela's comment on domestic capital markets. Daniela, so this is a problem that I have, and perhaps you can help me to articulate the narrative, but this is a problem that I have in mind. Take a country that has a very weak demand for domestic currency, and that when the economic agents of the economy save, rather than saving in assets denominated in domestic currency, they form foreign assets. They dollarize their portfolios, right? So there is no architecture or market that enables the economic agents in this environment to actually channel their savings towards investments that benefit the economy. And at times, the problem has to do with the loss of a safe asset, even in nominal terms in the economy. Like it happens when there's a default of the debt denominated in domestic currency. So it's the anchor for the development of domestic capital market. And therefore, we end up with a pool of financial resources in domestic currency that is too thin. And when the government needs liquidity, it doesn't have any access to domestic liquidity. And if there is somehow a creation of liquidity by the central bank, financing the deficits of the government, that extra liquidity goes to more demand for the foreign exchange and creates more inflationary pressures, right? Because it depreciates the exchange rate, and there is a history of inflation that people look at the exchange rate and say, okay, if I see the exchange rate depreciating, I expect inflation. That's what I have in mind. And perhaps you have better ideas for how to describe this.
Go ahead. Let me just point out that there's also one question in the chat, and we'll get to that before we close. But Daniela, why don't you respond immediately?
Sorry, but Martin, to me, this is a problem of creating a nominal anchor that restores somehow the overall trust in the domestic currency, not a question of developing local capital markets, right? Because you could say, well, bank deposits have the same problem. It could be a question of developing a bank-based financial system where the regular Argentinian wants to save in pesos instead of saving in dollars. It's not a question of the specific instrument per se or financial market structure, as opposed to a question of the nominal anchor.
Daniela, but the safety of the government asset in nominal terms, I see it as a necessary condition. It's the anchor of the system. Perhaps Argentina gives us so many. I mean, I didn't intend to go back to fall into Argentina's examples, but it's rich in those examples. In 2002, the country had its a big default after the convertibility crisis, and the central bank could not do open market operations by buying and selling treasury bonds because they were no performing. So the bonds were in default. So what happened? The central bank created its own note. It was called Levac. And then what happened next is that the deposits of the people in the banks that were not being channeled to investments, to credit to the private sector, ended up being channeled to the central bank. The central bank was absorbing that liquidity. So then the government started to have trouble after the restructuring to get financing in domestic currency because it had to compete with the central bank. And the banks preferred to send the liquidity, to transfer the liquidity to the central bank because they saw the central bank as safer than the government. And then when there are doubts about the safety of the central bank notes, which happened recently, what you see is that those deposits in pesos they start to be to go into dollars. So you see what I mean? So when you don't have a nominal asset that is safe, you have no anchor in the system. And it's very difficult to develop any other instrument in the domestic currency for which there can be a demand. And then you end up having more dollarization of portfolio. And therefore more problems. It's a vicious circle, more problems of financing, more currency mismatches in the economy.
True. Yes, we agree. But I think what you described is attempts to create one segment of deeply liquid, tradable local currency instruments issued by some arm of the state that somehow fail, right? So again, but maybe this is for when we meet and have a beer. Again, per se, the development of local capital markets is not the answer to me, in the sense that it requires a much more careful thinking through how does it relate to exactly to questions of nominal anchors, and just how do you get liquidity is not necessarily in a sense a finance question, but maybe a macro question. Anyways, I
agree.
Can I just point to the question that Gaston raised? And I think you're still on the call. Gaston, do you want to ask your question yourself, or shall I read it? You could turn on your video. Let me just, go ahead if you're here.
Yes, I can speak out myself. So my question would be what the role of actors that channel passive demand towards sovereign bonds would be, for example, rating agencies or index providers, and how maybe the relationship between ministries of finance and these actors can potentially affect monetary sovereignty of countries in the global south. I hope that makes it a bit clearer.
Okay, who wants to respond? You're pointing to Martin. Martin points to you. I
think Martin has a much better starting point to answer this.
You're muted, Martin.
Sorry. So I'm not sure I'm going to provide a satisfactory answer I should probably think more about this question, but what I can say, Gaston, is that credit rating agencies are super powerful. And I can give you the perspective. No, you asked for a perspective from the north, but let me give you the perspective from the south. Many governments fear them, and it's one of the main reasons why in sovereign debt restructurings, we suffer from the syndrome of too little and too late. That's how it's called in the literature, meaning that when there is a crisis or a situation of distress, it takes too long until the issue is approached by the government. The problem is, it's more complex than that. There are incentives both on the creditor and on the debtor side to avoid the recognition of the problems. Debtors don't want to restructure the debt, it's too costly. But certainly the role of credit rating agencies makes the recognition of that distress more costly, and it contributes to, it creates inefficiencies because a country that cannot recover means it produces less, and the size of the pie that to be distributed among everyone is smaller.
So I think Matthias thought there was one question still on the table that maybe Daniela could answer, and that related to the role of the relationship between central banks and private
actors.
Yeah.
Yes, sorry. So if I understood Matthias's question correctly, he was saying that the growing ownership of U.S. treasuries by hedge funds can be interpreted to signify a growing power of hedge funds towards the treasury.
Well, it fits very nice with what Martin said about the nominal asset that is basically safe and anchored. What happened during COVID was that this one safe asset, the treasury bond, started to behave erratically and in a manner that was not predicted by the experience or by the models. They thought during a crisis, the treasury bond will, be the safe haven, everybody will go there. But because the hedge funds were forced to sell a lot of treasury bonds, the treasury bonds suddenly started to lose value. And that was a huge shock. And the reason for that was because the hedge funds had become so big and that I think the Fed became very concerned about this.
I mean, having concerns so you can tighten regulations is not the same as saying that hedge funds. I mean, I don't think that there was a systemic shock per se. A fall in price is very different to me than that. And I'm not sure that you can draw such a kind of simple line between share of bonds that you own and your kind of, I don't know, infrastructural, political power. Not in the US. I mean, in the case of Argentina and other countries, when you have to do debt restructuring, then the politics of who's powerful is very different. But I would say the way that I read this, and this reminded me that I wanted to respond to Perry, that, I'm surprised that the wheels are not falling off in terms of the monetary transmission mechanism of monetary policy, not why we don't get financial stability, we agree. But when I teach inflation targeting regimes, the way in which the US economy has behaved over the last year and a half is not the way in which it makes it easier to teach inflation targeting. Let's put it this way. So this is, to me, the surprising thing is how ineffective, in a sense, policy rates are. And maybe I shouldn't be that surprised, but it's how ineffective they are in financial markets and how ineffective they are outside in kind of economic performance. So Matthias, I'm not quite sure that, I don't think I think, to me, the bottom line and the conclusion of my analysis, in a sense, of de-risking is that I don't think there is any potential for explosive instability in the system, simply because the Federal Reserve and others have perfected, the art of de-risking, and you can get tremors, but you can get some instability in some market segments, but it will not become explosive.
But that goes for the US. It doesn't go for the world, right? And so there could be feedback loops, no? And
no, I mean, it doesn't. It goes for the US. It goes for countries with monetary sovereignty. It goes for the US. It goes for the Eurozone. Well, I mean, not indefinitely, I suppose, because you can always have political strains that accompany this. But of course, the rest of the world is, with degrees of variance and on a spectrum, they are all hostages to the global dollar cycle.
So I saw Perry's hand go up again. It's 3 o'clock. I'm not sure whether Daniela and Martin, you have other commitments to get onto. Maybe we should just close the session, unless, Perry, you have a very succinct remark or comment.
I have 2 sentences. One is this treasury business, okay, is the cash and carry trade. These hedge funds were long the actual treasury bill and they were short treasury futures, and they were closing out that trade. Okay, that's the important thing. They were not. That's the important thing to understand. Second thing, another reason that the wheels are not falling off the cart is that all the central banks are coordinated. Everyone is raising rates with the Fed. Okay, they're not fighting the Fed. They're cooperating with the Fed. So it's the committee of central banks that is running the world, and they're in agreement at the moment. That's why the wheels are not falling off the cart. Wait until they don't agree.
Okay. Well, I think thank you so much. Thank you all for coming. Thanks in particular to you, Daniela and Martin, and thanks for your preparation of this talk. It was really fascinating to have these two perspectives together, and I think it really brought out very much the political of.
Thank you.
Okay. Thank you all. See you soon. Come back. We'll announce our program soon. Cheers. Bye-bye.
Thank you. Bye.
Thank you.
Bye.